Hello and welcome back. Today we are talking about IRAs versus Roth IRAs. I'm Patti Handy, your financial coach. We are discussing individual retirement accounts. As always, full disclosure, this is for educational and informational purposes only. Please seek the advice of an expert, whether it's a tax professional, financial advisor, attorney, should you have any questions. Let's jump right in. Okay, let's jump right into our IRA versus Roth IRA. So an individual retirement account is a retirement vehicle, if you will. And with a regular IRA, you get to gain a tax benefit today, the year that you make the contribution to your IRA. The dollar amounts will vary from year to year, so I won't quote a dollar amount that you can contribute because I'm not sure what year you're watching this, but it will change every year. And then there's a catch-up dollar amount if you're over age 50. So you get the tax benefit today, a deduction today, and all the growth, all the capital gains and interest and dividends and whatnot is accumulating tax deferred, okay? So over the years, over the decades, as it's growing, there's no tax consequences to you. Only when you take the money out, it then is ordinary income to you at the year that you take it out in retirement. If you take it out before age 59 and a half, there are penalties, so be careful of that. But it's growing tax deferred, which is nice, and you take it out and it becomes ordinary income at the time that you take the money out. With regular IRAs, you do have an RMD, which is a required minimum distribution. It's kind of the government's way of saying, okay, you've been saving money a long enough time, we want some of our money back. It's time to give back. So they require you to take out a certain percentage every year. After age, it's 73 right now. It's going to change, so I'm not, again, sure what year you are watching this. So check with your CPA and determine what age that is. And that RMD has to be taken out. You must withdraw that, and that's ordinary income in that particular year. Whether you need it or not, you have to take that money out. So be careful of that. There are no income limitations with a regular IRA, so that's a nice benefit as well. If you want to do a Roth IRA is, again, an individual retirement account, but as a Roth, it is growing tax-free. So you don't get any benefit today, the day that you make the contribution. There's no tax advantage today, but as all that money grows over the next decades, that's growing tax-free. Big difference, tax-free versus tax-deferred. Tax-free growth, and then when you withdraw it in retirement, it is tax-free income, which is a beautiful thing to have in retirement. We don't know what our interest rate our income rates will be at retirement. It might be lower than our current. It might be the same. It might be higher. We don't know. So if we can put a bucket of money into tax-free, that is a beautiful thing. Most people have a combination of both, tax-free and tax-deferred monies. So it grows tax-free, and that is a beautiful thing. There are no RMDs with a Roth IRA. The government doesn't say, okay, it's time, give us our money back. You didn't get a tax benefit when you made the contribution, so there's no RMDs. You don't need to take it at age 73 or 75 or whatever age it is. So when you take it out, if you don't want to, you leave it in there, and then you let your kids inherit it at some point later. It's a legacy play. So it's a really cool option for you to have with that. Now, with the Roth IRA, there are income limitations. And I won't, again, quote the income. There's a certain dollar amount for single, and there's another dollar amount for joint, married filing joint. And if you make over those certain income limits, and again, it changes year to year, so I won't tell you a dollar amount, but check with your CPA, whatever that year is, you can't do a Roth IRA. And get a benefit from it anyways. So there are some limitations there. There's what's called a backdoor Roth IRA. For those that make too much, you can fund a regular IRA and then do like a Roth conversion, put it into a Roth, and then it now becomes a Roth IRA, and you pay the income or the conversion dollar amount in the year that you convert it. It's a little bit more complicated, and there are forms to fill out that you want to work with your CPA on because you want to make sure you do this right. If you don't do it right, you don't file correctly, that can be a problem. So, but there is a way around it. The other cool thing about a Roth is that there's no age limitation. This is huge. So if you want to set up your kids at age 16, 17, 18, once they have earned income, they have to have a job and earned income to do a Roth IRA. And it has to be that minimum. So if, let's say, for example, it's a $5,000 Roth IRA limitation that year, or $6,000, they have to have made at least that dollar amount, that's $6,000. They can't make $100 and then do a $6,000, Roth contribution. So the cool thing is that you can set this up, and you can put your kids on payroll if you own a company, which is nice. That's a whole other conversation. But the point is that you can set your kids up with a Roth IRA and then contribute every year, let them contribute every year. And then over the next 40, 50 years as it grows, it's going to be crazy, insane for them to have this, huge dollar amount all tax-free. So what a gift that is. So that's kind of the high level, simple version of IRA versus Roth IRA. I hope that helps. Any questions, please always feel free to reach out to me. I will do a video if it makes sense for us to do a video on the particular topic that you ask. Please subscribe, like, and share if you find this useful. And I look forward to next time. Bye for now.